Hello, everyone. Welcome to video 4 of chapter 11. This set of videos, we're sort of talking about the various losses that can be included in income. We just finished talking about the allowable business investment loss in the previous video. In this video, we're going to discuss farm losses and what portion of them are restricted and unrestricted. So when you're undertaking a farming activity, it must be in pursuit of profit. If it's in pursuit of profit, then that farm functions like a business. We have farming income. Any farming losses can be entirely applied against them. If farming activity is not undertaken in pursuit of profit, then it's not considered a source of income. This is just a hobby farm. I'm just growing things for the fun of it. Me and my family usually eat whatever it is that I grow. So none of the losses can be deductible. Since we're not recognizing any sources of income, we don't get to apply those deductions. So those are our two positions. If the farm is a business, we include all the farm income, but we get to apply any losses from our farming activities. If it's not our business, if it's just a hobby, we don't include the income, but we don't apply the losses. Specifically for farms, there's this middle area regarding part-time farmers. Just to finish the slide, regular farm losses for full-time farmers, loss is deductible against any type of income. And then restricted farm losses, farming activity that meets criteria to establish source of income, but farming income is a secondary source. So what that's saying is regular farm losses are non-capital losses, like business losses. If the farming activity is not the main source of income, if I have a regular day job, but I have a farming, I guess you could say, business that I'm trying to get off the ground, but it's not yet my principal source of income, then that's a part-time farm. And part-time farm, not a chief source of income, have restrictions on how much of their losses can be applied to the income. So restricted farm losses restriction limits losses that can be deducted against other sources of income. If you have a part-time farm, the first $2,500 of your farm can be deducted against any type of income. After that $2,500, you can only deduct half of the next 30,000. So the next 30,000, half of that would be an additional $15,000. So the unrestricted portion is maximized at $17,500. Any farm losses above that 32,005 can only be restricted. So if you make 32,500, $2,500 of it is deductible against anything. Another $15,000 is deductible against anything, but so 2,500 plus 15, the remaining 15,000 up to that 32.5 is restricted. The unrestricted portion is treated the same as a regular farm loss. The non-deductible portion is called restricted farm losses. So we have farm losses that fall into two categories. One is streamed. Restriction farm losses are streamed. You can only deduct against future farm income. The reason for this is because they don't want, if someone's going to run a farm, there needs to be an expectation of profit. Now, it's understandable that getting a farm off the ground might incur some losses for a couple years. So yes, you can use them, but we want to restrict to encourage the individual to put more effort into getting that farm to a place where it makes money. So if you want to use these restricted farm losses, you need to carry on that farm in a way where it's going to produce profit. So I guess we'll come back to this one. So our farm losses is a bit more straightforward. We'll just go right into the exercise for it. Miss Elena Bodkin has a full-time appointment as a professor at a Canadian university. In her free time, she is developing an organic vegetable farm. In 2023, the first year of business, she had a farm loss of $36,000 and deducted the maximum allowable amount. In 2024, in addition to her employment income of $85,000, her farming business showed a profit of $3,500. Determine Miss Bodcom's minimum 2024 net income and 2024 taxable income, as well as any types of losses available for carryover. So this $36,000 is more than that 32,500. So we know that if the farm losses are more than 32,500, we must be hitting that maximum of 17,500 to be restricted and unrestricted. So 36,000 minus our unrestricted 17,500. So that 17,500 was unrestricted, and this says that they deducted the maximum allowable amount. Last year's income was already $80,000. I don't know if it says that, but does it say 80,000? For some reason, I have 80,000 in my head. It doesn't, but assuming that her employment income was roughly the same last year as it was this year, she had employment income already. So that allowable, that unrestricted portion, that 17,500, has already been consumed last year, leaving only the restricted portion to move forward. So we can only use those losses. That 18,500 can only be deducted once we have farming income. Did we have any farming income this year? Yes, her business showed a profit of $3,500. So we can take our restricted losses and we can use $3,500 to subtract from our taxable income. So that's going to leave $15,000 of farm losses still to be used in the future, but $3,500 can be used now to protect that income. So it looks like this. So in 2023, we had to figure out how much of the $36,000 was used as unrestricted farm losses. We took the first 2,500, then we took half of the next 30. That consumed 17,500 for unrestricted farm losses. She used those against her employment income. From the 36,000, she used 17,500. It left 18,500 on her account to use against future farm income. This year's employment was 85,000 and then farm income was 3,500. So net income, her net income number was 88,500, but then we get to subtract our restricted farm losses as far as the farm income allows. So we got to remove $3,500 of income. Our taxable income is back to just the 85,000 employment income, and $15,000 is still left of our restricted farm loss to carry forward. So we hopefully, if this taxpayer continues to work that farm, we started to make a profit. So hopefully it grows next year. We can make another $15,000 of farming profit without having to worry about paying the taxes on it because it will be deducted from income. Non-capital losses and farm losses. So if we do have these losses, they can carry back 3 years and they can carry forward 20 years. The expectation is that at some point in the next 20 years, surely you will earn income. Non-capital losses and farm losses are applied against any type of income. There's no streaming. The restricted farm losses apply only against farm income. This is a streamed loss. Net listed personal property, which we talked about in an earlier video, can carry back 3 years, can carry forward 7 years, only applied against net LPP gains. Our net capital losses carried back 3 years, carried forward indefinitely, but they can only be applied against net capital gains. If we have limited partnership losses, those cannot be carried back and is only deductible against income from the same partnership. So up to this point in the videos, we've covered a series of losses. There's a summary of it. In the next video, we're going to talk about capital gains deduction that can be used to protect capital gains. And then in the future video, we will deal with if you have multiple types of losses, which ones do you want to use first? And that's going to be called order of losses. So thank you for your time. I'll see you in the next video.